Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, October 5th, 2016. I wanted to do an update on the gold and the gold mining stocks, as well as I'll make a few comments on the broad market. Keep this one relatively quick. There's been, as you know, a lot of movement in the gold stocks yesterday. Today was sort of a muted trading day, relatively speaking, of course. And I'll go over the charts, share what I've follow up on the things I pointed out yesterday, such as the potential divergences in GDX, take a quick look at some of the key mining stocks, and again, just touch on the broad markets real quickly. All right, so this is GDX. This chart's busy, has a lot of lines. We'll look at a clean board in a second. But what stands out and what's been highlighted all along are these divergences. You know, I can put a very heavy weighting into my analysis on divergences, positive divergences being bullish, negative divergences being bearish. And, you know, in this case, this chart's been covered many times. Each and every one has played out for either a rally or a correction. And now we have, as I pointed out yesterday, what I refer to as potential divergence. This might not be in the textbooks. It's just how I trade, what I look at. Potential meaning at this point you have the MACD and the RSI both making higher lows, yet they're still headed lower. So for me, as I often say, confirmed it would be if we have a bullish crossover, meaning the 9 EMA and the MACD lines cross and turn back up before they take out that low over here back from what's that? Looks like September 1st or so. So potential divergence is somewhat bullish, especially with the fact, as I mentioned, GDX at support. We have this big gap back here, that gap support level, and you know, so far that's held. So you have a couple things. You have oversold as well. The RSI, you know, just bounced off the 30 level. You have oversold at support with divergences, and as I mentioned yesterday, those three ingredients alone tell me do not stay short. We had a nice run on the miners. They could go lower. I'll talk about that here. Again, as that divergence is only potential. Let's look at a few other boards on GDX. We're still in the daily time frame. This is a little more clean, not as many annotations, so you can see the different levels. There's the bottom of that gap right there, and again, I'm referring to this gap back here from looks like early June. Big gap, and gaps are typically, you know, pretty significant levels, often act as support when back tested from above in that case. And this gap also lines up nice with this reaction high back here from early 2015. So certainly a support level, certainly a level that might launch a rally. For those of you that gold members that are in the trading room, I posted this today down here while GDX was still in the wedge, just as I posted as a short term, a day trading op or a short 1-2 day trade. And GDX did go on to break out of there, and it was good so far for about a 3% rally from where it was posted, and broke out right after that and hit the first and even the second of the two targets. And it looks like if this is maybe going to be an ABC correction, with this being the A up, and then you have this sort of a bull flag pattern, possibly. We'll see. We'll see how this pans out tomorrow right here. And that might be our B down. And then we could get a C up tomorrow. And that would allow us to hit that final near-term target around 24, which I'm looking at. So, you know, I day traded this, took some off before the close just to be safe via Nugget, because I don't plan on being in there long. And if I can get close to 24 tomorrow, anywhere a little shy, maybe around 23.90 or so, 23, yeah, around there, then I'll probably just get out, even though that could mark the bottom, because what that'll do, if there is more upside here, that will then help the bullish scenario. I jumped over to a 60-minute chart. Now, the other day I was pointing out the potential divergence. Now, that divergence is really being stretched to its limits. As I take this line down here on the MACD, you can see we're right now right at about an equal low. Now, that's still bullish divergence or positive divergence, because you have, let's just focus on this line right here. Prices in GDX making a much lower low, while the MACD has failed to do so. It hasn't made a higher low, but it hasn't made a lower low. So that's divergence. Sometimes I've heard it referred to as flatline divergence. And there it is. You see it on the trend 1333 trend indicator, as well as the RSI. So just about flat. And So the divergence is there, hasn't yet been confirmed. Somebody asked me today, will I let them know if it's confirmed? Very close. See that crossover? It looks like the 60-minute MACD is poised to cross on any more upside in GDX. So we could get it, and that may possibly mark the end of this pullback. But as I mentioned, there was some very bearish action. We dropped down from this trading range yesterday, and we'll look at a few other boards. Let's see if I have anything else worth mentioning on GDX. No, let's jump over to gold. This is why I'm only lukewarm, bullish, or open to the idea of a bounce, but not at this point. I don't have the confidence to put this gold or the GDX or any of the mining stocks back on as official swing trade ideas. First of all, after such big moves, you tend to have some back and forth. You could have a reversal and a move up to new highs, but it might take a while to digest these recent this drop. Maybe we trade around sideways for a while, but more importantly, we're looking at gold. And excuse me, because I did want to go back on GDX and mention one thing that I didn't highlight, which is definitely worth mentioning. I talk about trend indicators and how I use one of the most simple and effective trend indicators is looking at the MACD or PPO using the 9 EMA, which is the white line here below. And when that's above the 0 level, the trend is bullish. And when it's below, as it was for almost this whole time period here, the trend is bearish. And as you can see above, bullish. Told you almost the entire rally throughout 2016. Once that white line, the 9 EMA crossed right here, you had a bullish trend. Now it is clearly in bearish territory, not even close to the 0 line. So, this says that we could have a lot more downside. Maybe not so much in price, but possibly in time. But the bottom line is this is a trend indicator is clearly in bearish territory right now. So that's just giving me pause. The key to trading is you don't always have to be in the market. You don't always have to be in any certain sector or stock that you're trading. I know the allure to gold and the gold mining stocks is incredible because the gains can be very powerful. But I'm, being a little cautious right now as far as, adding back exposure for a swing trade. Now let's get back to gold because as I always say, it doesn't matter what the charts of GDX look like, the miners will follow the metal. That is just one true constant. They're just a leveraged play on gold. Gold goes up X, the miners go up X times 2 or 3, and vice versa. So what do we see on gold? Well, first of all, we do have the trend indicators, at least by that 9 EMA, the signal line on the MACD, in bearish territory now. Not very far, but it's down there. It's crossed down into below the 0 line, and it could whip back up. Just something to watch. Gold is oversold on the RSI. We're looking at the daily time frame here. Oversold in itself isn't always a buy signal, but it does tell you don't want to stay short, especially if this is a bullish trend. So here's gold at support. I had the support zone here. I've added a second line slightly below. So gold is definitely at support. This is a long-term support zone, or a support zone that I've had on the charts for a long time, I should say. And if you go back to the left, you see what defines that. You have a gap and then a couple reaction highs here. You have reaction highs here. You have a reaction there. You have two big gaps and reactions above. There's an island top right there. You have a reaction to the left. So I think that's a fairly well-defined support zone. And there's a good shot gold could hold support there and bounce. But right now, I don't see anything in the MACD that tells me that. The MACD lines are clearly pointed lower. The RSI is pointed lower. So it's a catch a falling knife trade. Oversold at support, especially if this is a new bull market with plenty more upside to go, usually does prove to be, in hindsight, a very good buying opportunity. But might be a little too early to say. Again, it's define your risk tolerance, your trading style. If you want to take a shot here, let's just say you want to go long gold or the miners, you can go along here at support with a stop not too far below. But if things do get ugly, there's certainly the potential for more downside. This was a target I had early in the year. With this, you can see the divergent high there. That target was hit, and that's a pretty key level, that 115.70-ish level. Numerous reactions, including that last one there, reaction some reactions to the left. So there's the chart of gold. So on the bullish side, we have oversold at support. That makes a case for a possible bounce or even the end of the downtrend, the pullback. Although the charts aren't screaming buy right now. That's the thing, and they could firm up here shortly. Let's take a couple other look at a few other things. Here's another board, same daily chart of gold. Very clean. You can see we had a divergent high, very clear and powerful divergent high. Rising wedge pattern. You can see the white lines there. That broke down, and then you had this secondary or primary uptrend line that prices broke below, back tested, and rolled over. So is that enough for what we see here? Certainly it's a pretty decent correction, decent pullback in gold, especially if gold is in a new bull market that has a lot more to go. Then that may be enough, but it may not. Let's see if I have some Fibonacci's. Well, I can put them up real quick. Let's find a clean board and just look at the Fibonacci retracements. So there we are. We're close to a 32% retracement, which would fulfill a pullback. We're getting very close. So I could see a little more downside to maybe hit that level. There are a lot of traders that watch and trade off these fibs. That level also comes in, if you note right here. Let me just highlight this for you. You can see a lot of reactions and gaps as I'm highlighting here, and that again, that big island top back here with some gaps there. So maybe a little bit more downside in gold. So if you were to go long here or start scaling in, would probably be the more appropriate strategy if you want to reposition long for swing trades. Maybe start scaling in. When you do it with the miners, you have to use smaller positions and allow wider stops because they're more volatile than the metal itself. So that's it. And again, if it gets really ugly, that 50% Fibonacci level right here, you can see the fib levels over here on the left, would line up with that next downside target area I was talking about, around 115.70 or so on GLD. I said there were some comments I wanted to make on the broad market or look at some similarities. Okay, this is the same daily chart of gold we were just looking at, a different board. And these are things I've pointed out in the past. We had a series of 3 consecutive divergent highs. Some of you might already know where I'm going with this if it sounds familiar, if you've watched my market analysis over the last 6 months or so. You'll notice the similarities there. So we had the first divergent high here. You can just see these lines. So you had a divergent high at this point, and that was a bearish rising wedge pattern. See right here. You had the top, and you had a correction, and it was a sizable correction too. But it wasn't the top. It wasn't the top. A drop of about 7% gold, which led to obviously a much larger drop in the miners. What happened from there? We pushed on up. So we had just a correction, a run-of-the-mill correction, pushed up to make a second divergent high right here, as you can see with the MACD and the RSI making lower highs against a higher high in price, and yet another correction. From there, we pushed up once more, formed a third consecutive divergent high, which really made one larger, if you look at this trend line, I'll color it, we'll make it yellow just to stand out, an even more powerful divergent high. And what did that lead to? So you had a series of 3 smaller divergences that made up one very large, very powerful divergent high, and that led to the biggest correction that we've seen in at least the last year in gold. So that's the drop. Now let's take a look at the market. And let's go to a different board. And here's the SPY, the S&P 500. I think I have this drawn better on the SPX. Yeah, there it is. Okay, same thing I've talked about before. We had it back here in late 2014 and early 2015, 3 consecutive divergent highs, which led to one very large divergent high. From this point to this point, those 3, each divergent high along the way resulted in a correction. That's correction 1, correction 2, correction 3. And then from this point, being the top, we had a huge, and this was actually in some indices a bear market, by definition a drop of more than 20%. The SPY didn't drop. The SPY only fell about 15, 16%, but some other indices dropped over 20%. And that's exactly what we've had, and I've been harping on for a long time. I know it seems at this point like it may never play out, and there's nothing guaranteed in trading and investing. It might not, but right now I'm seeing one divergent high. We had a healthy, decent correction, second consecutive divergent high, even bigger correction, and now a third divergent high. All three really make up that one large divergent high. Prices have started to roll over, so that is still a divergent high. The MACD is crossed now into bearish territory, and well, this trend line really doesn't do anything because that divergent high was finalized right here when prices made the higher high. So so that's worth noting. Now, another similarity when we look at gold, just for example, we had that after the breakdown, after the divergent high, prices moved, they consolidated in a range just above support. And you can see right here, this whole area. Let's shade it in. And as I mentioned yesterday, when we finally broke down, that was a level, a battleground between bulls and bears, if you will. When we finally broke down, the move was extremely impulsive, especially in the mining stocks. And that seems to be very similar to what we have in the S&P 500, except it hasn't broken down yet. And I can draw this in many different ways. I have a trend line drawn here, so you have a little uptrend line to watch. And ultimately, if we drop below that level, especially below those lows from that recent trading range, I think you'll see the fireworks turn on, just like they did in GDX yesterday. So the first sell signal would be a break of that level. Again, I'm watching this closely on the 60-minute charts, but just because I don't post an update on the daily charts every day doesn't mean that there isn't anything new to update. So until and unless we break below these ranges, or for the bullish case, take out the previous highs, burn through these divergences with the MACD and the RSI going on to take out the previous highs and erasing or negating those negative divergences, the bearish scenario is still my favorite and preferred scenario. And I think based on the scope of these divergences, I don't see any reason why this correction won't be as big or bigger than the preceding top, or the preceding correction. Okay, two other quick charts. We'll wrap it up here. Keep this one relatively short. This is the Wilshire 5000, which is, as I often say, probably one of the most representative, complete, comprehensive indexes, with nearly 5,000 components. It gives you a good idea of really what's going on in the overall market. As I mentioned, the Qs, or NDX 100, as popular as it is to trade, as beloved as it is because it has so many tech stocks that everybody loves and wants to own, Google, Facebook, Microsoft, that is not a very diversified index. It's not representative. It's excluding some key sectors in the economy, and it's only 100 stocks to boot. And of those 100 or so, the top 10 make up over half the entire returns of it. So you want to get a good idea of what's going on in the economy, what's going on in the market. You look at this Wilshire 5000, or I'll show you the Dow Jones Global Index in a second here. But that's it. I mean, this chart speaks volumes to me. It's these trend lines, these divergences. Nothing is 100% in trading, but you go back in time, you can see the divergences here: negative divergence, a rising wedge, and a breakdown and a correction. Rising wedge with negative divergence or a divergent high, correction. You have this dotted line shows a divergent high there. You can see, every time you have the lines, these are negative divergence, and you had a breakdown. And besides the divergent high, you have a well-defined uptrend to watch in each of these instances. There was a breakdown, prices pushed back up, made another divergent high. This was that three consecutive divergent highs that I showed you on the S&P 500 chart a minute ago, and then finally the big correction leading into early 2016. And here we are again. Very clear, unmistakable negative divergence as the Wilshire wedges higher. So this is just really a different spin on a different index. But this is what I call a nearly or fully mature bearish rising wedge pattern. By that, I mean prices are close about to the point at apex, usually 65, 70% or so to the apex of the wedge. When they break down, just as it did here, This one got really close, right up to, much closer to the apex of the wedge, and this one got a little bit closer. So there's no hard set rule on where they're going to break out, but what you watch for these trend lines, and look how we're dancing right on that trend line. So one day, it can take one bad day in this market to spark a a powerful sell-off. Now maybe it's a little blip down and a back test. I don't favor that at this point. Sometimes you break down like you did here, come up and then drop down, and then other times the selling is very sharp and impulsive right after the breakdown. So either way, something to watch, and like I said, the technicals clearly remain bearish. It's not drawn out here. I'll just use this arrow tool. You still have that very large divergent high there. Imagine that was just a trend line, not the arrow tool. And one other to look at. This is the Dow Jones Global Index. You can see the name up here. And here you have, wedges and breakdowns, especially if they're confirmed with divergent highs. Here was one that had a quick breakdown, no back test. Sometimes you back test these wedges, and many times you don't. There was a discussion on the site recently where someone thought you shouldn't short a breakdown of a wedge because it always backtest. And from my experience, yeah, it does sometimes. But if you sit and wait for a backtest, you're going to miss so many lucrative shorting opportunities. And sometimes you can get a feel from the charts on which ones might backtest like this. You can see that backtest there, but it wasn't. Even if you shorted the breakdown, the backtest was not at much higher levels. So you would have caught, I'm not saying you could catch, or you could, but not saying you would have caught every bit of that trend. But either way, that's the follow-up correction that came on the heels of that wedge breakdown. And this current rising wedge is very clean. We had a little whipsaw signal here. That may be an erroneous print or something else, but I think that's a very valid trend line. You can see a lot of reactions. Prices are hugging there. And this is, once again, a fully mature and very steep bearish rising wedge pattern with steep divergence in place. And when this sucker breaks down, I see nothing less than a correction, of well, these lines are targets, and where we go from there. Also keep in mind, the longer term, the weekly charts have divergences and everything else that say one of these wedge breaks could be the catalyst for a much deeper move. Beyond what we've seen, beyond this correction that we had here. But at the very least, right now, despite the frustrating sideways trading range in the market, despite the facts that some stocks seem bulletproof and resilient, like Amazon and Facebook, they're not. They are until they're not anymore. And when the real selling in the market starts, those stocks are overowned and overloved. There'll be a rush for the exits. People sell and the funds liquidate what they have to sell when there's a sell-off. There's forced margin calls, there's mutual fund redemptions, and when mutual funds get a redemption, if you call your broker, say, blow me out of my large cap tech fund or whatever you're in, or my S&P 500 index fund, that order goes to the fund company, and just like you or I, they have T+3, trade plus 3 settlement days to get that cash out. So if they don't have it on hand, and a lot of times these fund companies run low, 3% or less cash on hand, they have to sell what they have. And what do they have a lot of? Amazon, Facebook, and the likes. So those companies, good fundamentals or not, of course, they're all overvalued because that's where everybody's been chasing. The money's been funneling into the fewer and fewer names, which is, something else. I don't want to digress too much. This wasn't meant to really be a broad market analysis. I wanted to touch on gold and GDX, update you guys there, but then also, really kind of tie into the fact that just like gold had that triple consecutive divergence, which led to one large divergent high, and you see what happened with gold, especially GDX, the market has it too, has started to roll over, but the real selling hasn't kicked in yet. And it appears to me that it will, unless these divergences and these bearish patterns are taken out. And it's a possibility, but one, I'll just be very clear, I don't see it happening. But if it does, if we get above those recent highs and all of these indexes, then and we see these, especially if we see these divergences burned out, and we start seeing more and more stocks participate on the advances, breadth improves, then it's possible that this was all just a multi-year sideways consolidation or deer market before the market goes on and thrusts up into the next leg of the greatest bull market in history. All right, well, I'll leave it here. This has been Randy Finney with Right Side of the Chart. And remember, guys, if you like the video, give it a thumbs up. That does help on the YouTube channel, so I'd appreciate it. Have a great evening.